Good morning.
Mommy.
How are y'all doing? Y'all miss me? I'm,
Okay.
I am doing much better. Thank you, Miss Vam, for asking. I ended up with earache, sore throat, upper respiratory, the coughing and all that. But I am, the antibiotics are helping, which, I because antibiotics are helping. If it was the virus, it wouldn't be helping. So I'm doing better. If I cough, don't freak out. Remember, we've got lots of social distancing. It doesn't come through the computer. Although I do not think I have the COVID virus because I am reacting to antibiotics, and obviously I wouldn't be if I had the virus. So it was very concerning, but especially because of my shortness of breath. But I'm going to teach for 6 hours today, and y'all are lucky. The first one, I'll have hopefully all my breath. So while we're waiting for the class to start, looking at the grades on the quiz that not quiz, but just assignment y'all had for number crunching, chapter 9. Most of y'all did very well on it, so I'm pleased with that. However, when the class comes in, we'll have any questions that you had with going through the calculations for all of the different types of retail inventory methods, the average, the conventional, the LIFO retail, the dollar value LIFO retail. And then we'll get into chapter 9. I assume, I can't remember because I just have been feeling poorly and that sleep, oh my gosh, anyway. If you look in course content information, did you see that I uploaded the chapter 10 notes that, are things that I normally write on the board? I went ahead and word processed them. So in course content information, excuse me, there is, do you see the chapter notes? And then below it is a PDF file that is a decision tree that I have found very useful for students when we are getting into the capitalized interest that you read about. The calculations there are, a number of calculations, but that decision tree should help you understand it when we get into there. So I did upload those. Good morning, good morning. I see we're back in my favorite periwinkle bedroom. I just love, what color do you call it, Taylor?
I mean, I just refer to it as blue.
As blue. Well, there are all kinds of different blues. And
I don't know. I haven't really gone into much thought about it.
Well, look up periwinkle. It looks like periwinkle to me. It's one of my favorite colors. So I have a beautiful cocktail dress that is periwinkle, and I just love it. So good morning. And I'm sorry, the first class that we cancel this semester is, during the online part, but looking at the results, your grades on the, I'm sorry, I guess I am kind of still foggy. Looking at the results on the homework that you did for chapter 9, Y'all did very well on it. Most of you got the 20 out of 20. However, I would like to get some feedback about your experience with it, so that if there are any questions that I can help, if you had trouble with some calculations. I'm sorry, this closet door. That's where all our office supplies and stuff are, and so we've been going in and out of it quite a bit. So I would like to, before we get into chapter 10, I would like to hear about your, would you mind fixing me a cup of coffee, please? Thank you, Splenda and cream, thank you. I would like to hear about your experience with the calculations, thank you. So how'd it go? Difficulties?
I think about LIFO dollar value. When I calculate the first year, it's okay, but then when I calculate the second year, it's quite take time and quite difficult for understanding for me. Only this method.
Right, because remember when we learned about LIFO, in LIFO we have to, I mean, in FIFO you do too, but you know, remember what's in ending inventory in FIFO are current prices. So in LIFO, we've got those layers, and the layers are, you know, can be from older prices. So what you have to remember, both in LIFO retail and in dollar value LIFO retail, that you've got to calculate a cost to retail percent for each layer. And then of course, because of, remember, we talked about that under LIFO retail, that one of the assumptions was that prices were stable during the year. And that's not in many cases, that's not a great assumption, because we know that prices do change during the year. So you've got to calculate a cost to retail percent. And just like we did in dollar value LIFO, you've got to determine, did I add a layer or did I subtract a layer? And then once you have determined whether you have added a layer that second year or third year or fourth year, but we just had 2 years, once you've decided whether you've added a layer or liquidated a layer, you then have to apply both the cost to retail percent for that layer as well as using the index. Okay, so I can, Ms. Pham, what I can do is, I'm sure by now, between the chapter 2 Connect homework, so y'all must have had a number of calculations to do yesterday. When I, you know, sent that out for class, then I also saw, actually I didn't realize it until this morning, that you also had the chapter 9 Connect 2 homework due. So boy, y'all got inundated with a lot of calculations. One of the things when I noticed that this morning was, I noticed that some had not done the part 2 chapter 9 Connect homework. And I assume it was because you had the 10 problems to do that I assigned for, you know, class, and then the chapter 2 Connect, and may not have realized that they were both due. So one of the things that I did this morning, because I have to do it before, thank you. Oh, cream.
Just only cream.
That's all?
I'll do it back, taste it, and I'll go ahead more.
I like
It's not
Thank
gonna
you.
work. It's not gonna work, but that's okay.
Okay, just add more to it. Sorry about that. Oh, what I did this morning was I had noticed that some had not completed the part two, regular part two Connect homework. And again, I can assume because you were so busy with the other that you didn't even think about it. So I extended the till due at tomorrow at 8 o'clock. So if you forgot to do it or didn't have time to do it or need a redo on it, I did extend the time on it because I have to do it, before it's actually due and goes into study mode. Thank you. That's better.
You think it is.
I think it is. That's good. Thank you. So anyway, Ms. Pham, what I can do is between the work that I had done, or everybody, the work that you did in Connect for the assignment for Tuesday and the Connect Chapter 2, you've worked a number of problems that are end of chapter problems. What I can do is I will write some practice problems for you to do and practice more for the exam. I had practice problems for the prior exam for y'all. So I will write some for chapter 9 if that will be helpful, particularly with the, did y'all find that the LIFO retail and the dollar value LIFO retail were the more difficult ones?
Actually, every other method I do well, only just the LIFO dollar value. I take more time than the other. Just that it's not difficult. It just take more time.
Oh, yes, it does take, especially the dollar value LIFO retail, because you're having to not only calculate your cost of retail percent for each layer, but you're also having to deal with the index like we did in DVL. So I will push out some practice problems for that. How were y'all able to handle the employee discounts?
Yes, I can.
Yeah, we're able to handle that and calculate it because, a lot of this is just high school algebra, that if they tell you what the net sales were, of course, we need to subtract it at the gross amount. So you need to figure out what the gross sales, see here I go, where the gross sales to the employees were. And I assume y'all figured out the math on that. Seeing the problem 913. Okay, so any other concerns about chapter 9 before we get into chapter 10? We had the LCM, the LCNRV, and then the 4 methods, average retail, conventional LIFO retail, and dollar value LIFO retail. So I will give practice problems with the LIFO retail and the dollar value LIFO retail so that you've got them for the exam. Were there any other questions about them before we go into chapter 10?
Are they gonna be as long like that for the exam? Because those are really time consuming.
There won't be as, obviously there won't be as many, like maybe there would be $1 value LIFO retail problem, and so it seemed long because I had you doing several because of the repetitiveness of learning that we do. So if the dollar value LIFO retail, which takes longer, you wouldn't have any more than one problem between multiple choice and a problem. Whether it's a multiple choice problem or a problem, there would only be one of, not one of each, either one in multiple choice or one in a problem. Okay, because I do understand, Taylor, the the time constraints, because you've got 4 chapters you've got 4 chapters on this test, 2 on inventory and 2 on long-term assets. And as you read, you haven't done any number crunching, but as you read, for the capitalization of interest can also be a time-consuming, calculation to do. So I'm very sensitive to the amount of time that it does take to do the problems, but you've got to at least know what you're doing so that you've got time reduction because you've practiced it enough. Okay, so I really try and be very, very sensitive to the amount of time that I know these calculations take. Okay, so for those of you that may not have heard when I first came in, I don't remember if I put out an announcement or not. If you look in course content information, there is chapter 10 notes that I word processed during my trying to feel better. I pushed out some, I already found a typo, but I'll fix it and put it up. It's not anything major. But I do have some chapter 10 notes. If you can pull those up, it's really where I have summarized all of the major points on chapter 10. Now, chapter 10 is about initial measure of long-term assets. When we first acquire the long-term assets, what do we capitalize? And just like that concept that we had for inventory, that we're going to capitalize all costs necessary to get the asset ready for its intended use. So that same concept applies to long-term assets. There are 3 major categories, as you can see on the chapter 10 notes. There are 3 major categories of long-term assets, and those are our tangible assets, our intangible assets, and then natural resources. And on the notes, I have beneath each one the particulars about those. So let's take a look at property, plant, and equipment. And let's first look at the types of cost that are capitalized in our tangible assets. What costs are considered to be necessary costs to get the asset ready for its intended use? On page 517, they've got illustration 10.4 that shows an example of cost for acquiring equipment that would be considered necessary to get the asset ready for its intended use. Obviously, the purchase price. Of course, if we have to pay the freight, the shipping cost would be capitalized. If we have to, in this case, they said build a platform. You can see that if I've got a heavy piece of equipment and I've got to build a special platform in order for, to handle the weight. Remember, to get it ready for its intended use, the intended use is that I can turn the equipment on and it works. Another thing here, I use the example often in class, is that I get this piece of equipment, and what if I have to redo the electrical work because this piece of equipment takes more than what our plugins that we have to plug in a lamp are, that I have to call an electrician out in order to redo the electrical work. Well, that would be capitalized because I wouldn't be able to plug in the equipment unless I had the proper electrical work. So if you can just think about, was this a necessary cost to get that asset ready for its intended use, then it would be capitalized. Now, with respect to tangible assets, one of the asset types is intangible assets is land. And I would like to take a look at illustration 10.5 on page 517. Now, land is a tangible asset, but it is a tangible asset that we do not depreciate. We do not depreciate land, because land is there, and we don't depreciate land because it is around in perpetuity. Okay, but look at some of the costs that are capitalized with respect to land. Let's say that I found a piece of property that is going to be the perfect location for me to build my corporate headquarters, for example. And the land that I purchased has a building on it, but this building is not going to work for my corporate headquarters. So the intent when I purchased this land that had a building on it, really what I wanted to buy was just the land, because my intended purposes are to have a clear site of land so that I can build my own corporate headquarters on it. So because my intended purpose for buying this land that has a building on it is that I want clear land, let's take a look at some of the cost that would be capitalized on illustration 10.5. The purchase price, we get that. Title insurance. Now, most of the time, our insurance that we buy is our insurance for any kind of liability that we may have. And every year we buy insurance on our property to insure it against, any damages that may happen, any liability that we may have happen on it. That insurance is expensed every year. I don't have to have insurance in order to own this property. Now, title insurance, though, is different. Title insurance does anybody know what title insurance is? Title insurance, and I didn't give anybody a chance to answer that question, because I assume most of you may not have purchased property where you have to get title insurance. But title insurance is just a one-time, when you're first buying a piece of property, that in order to make sure that you've got clear title to the property, a title company will do a title search to make sure that there's not any claims on that title. For example, did any of the prior owners have where somebody had sued them and had attached a lien? That's the word I'm looking for, a lien on the property. So a title company will do a title search to make sure that you have clear title to the property, that there aren't any liens on the property that would have first to be satisfied before you could get clear title. And then the title company will provide you insurance so that if something comes up and they didn't do a good enough search to make sure that you have clear title, then you're insured against that. If you are borrowing money to purchase property, the bank or whoever you're borrowing the money from is going to require that you have title insurance, because If you default on the loan, then they get the property. And of course, they want to make sure that they've got clear title to the property. So because we are required to incur the cost of title insurance to get the property to begin with, it is a capitalized expense, a capitalized cost, instead of our regular insurance, ongoing insurance, which would be an expense each year. The commissions, this has to do with the real estate commissions, or, we've got to pay commissions to the real estate agent that was involved in the process. Now, the fourth one that is listed is delinquent property tax. Property taxes are an ongoing tax that companies have to pay on their property and tangible assets. That would be an ongoing expense. Property tax expense would be an ongoing expense. But notice this said delinquent property taxes. If you are acquiring the property and the previous owners are delinquent or have not paid the property tax, the only way that you can get clear title to the property is for the property tax, any delinquent property taxes, to be paid. And if the seller doesn't pay those property taxes, then you've got to pay those property taxes. And so because that is not technically your cost or your expense, because you didn't own the property when these property taxes were supposed to be paid, and you've got to pay them on behalf of the seller, then that would be a capitalized cost because it wasn't your property tax, but they've got to be paid in order for you to get clear title. Now, if you think about it from an economic standpoint, not even from an accounting standpoint, hopefully the selling price would be reduced. If you're paying the property taxes for the seller, then when you're negotiating the selling price, hopefully you're negotiating, hey, look, I've got to pay your property taxes, so we got to reduce that selling price. So that's just a little bit of information from having been a property purchaser before with negotiations. Okay, so any property taxes that you pay that you are responsible for as owner would be expensed. It's only the property taxes that you're having to pay that were not taxes when you owned the property, those delinquent property taxes, that would be capitalized. Now the next one, cost of removing the old building. That would be capitalized because remember, the intent was to purchase, we just wanted the land. We want the land to build our corporate headquarters on. And so because our intended use was land, to just have the land, then the cost of removing that building for me to have clear land would be capitalized. Cost of grading. Grading, this isn't, the cost of me grading something. Grading is grading is the verb that is used to flatten the land, get the land, flattened so that I can build a building on it that, isn't crooked, okay? So grading, in case you didn't know what that word meant, grading is actually leveling the property so that, it's flat. Okay, so that's what cost of grading is. And obviously, after you remove the building or you remove any trees that need to be removed in order to build your building, then you would have to grade the land so that it's at the appropriate level. So that's what grading is. Again, you think about that intended use. Did I have to incur this cost to get this asset ready for its intended use? Now, we're going to see in chapter 11 that because chapter 11 is about subsequent measure of long-term assets. We're going to learn in chapter 11 that cost allocation for tangible long-term assets is called depreciation. Okay, it's called depreciation. And the depreciation, well, in chapter 11, there's several depreciation methods that we will learn about how to cost allocate the tangible assets, okay? All right, let me find my notes on that. Another thing is lump sum purchases. Look on page 525 and 526. Often, say I did find some property that would be great for my corporate headquarters, but the building is perfect. So I buy land and building for my corporate headquarters, and I pay one price, just like we do when we buy a home. I bought my home, and that included the land and the building. Well, we have to separate the purchase price into how much of the purchase price goes for my building and how much of it goes for the land. Can anyone think of reasons why we would need to separate the selling price into the different components that I bought?
They have different useful lives.
Okay, great, Lillian. One, they have different useful lives. That a building is going to last a whole lot longer than, say, that in the building that I bought, that the company is leaving their office furniture. They had no use for the office furniture. It's perfectly good. And so I bought land, I bought the building, and included was office furniture. Well, obviously the building is going to have a different useful life than the equipment would. So good, Lillian, that different useful lives. What is another reason that I would need to separate the, especially with the land? Why would I need to know what the cost of the land was?
It has different characteristics than the land, building, and equipment.
Well, right, it has a different characteristics, but what is one of the things that is unique about land, Catone? What
Doesn't
is
depreciate.
tangible asset? What is unique about it? It what?
It doesn't depreciate it.
Perfect, it doesn't depreciate. So because land is not, we don't depreciate land, we need to allocate the cost of that land out, because that part of the selling price would not be depreciated. So let's take a look at exercise 10.3. Exercise 10.3 is on page 553. So here we've got a company that is purchasing land and building for $4 million. And they have some additional cost, you know, the title insurance, the legal fees, the property tax, and then you also have to pay state transfer fees, which are, I never understood that. I hate paying transfer fees, but the state's required. I guess it's income for them. And so we've got a lump sum purchase, as well as understanding what cost would be capitalized. I'm going to pull up an Excel spreadsheet, and let's work this problem together. And I'm going to share screen with you. Oh, sorry, I shared the wrong one. Why is that one keep coming up? I'm just gonna close it out. Okay, there we go. So do y'all see a blank Excel?
Yes.
Okay, perfect. Right, so one of the things that we've got is we've got the purchase price, and the purchase price is 4 million.
Can you make the screens?
There we go. Is that better? All right, so we've got the purchase price of $4 million. Now, in addition to the purchase price, we also had title insurance, and the title insurance was $16,000. Now, would I capitalize or expense the title insurance?
Capitalized.
Good, we just talked about that. So we would capitalize the 16,000, the 16,000 of title insurance. Okay. Now, thank you, Bill. The next item is the prorated property taxes for the period after acquisition. Okay, so this would be the property taxes that have to be escrowed, but for after acquisition. When you first buy property, you've got to prepay the property taxes. I know a lot of this is stuff that, I mean, when you haven't bought a home or something, it's when you get into the closing cost of the home, your mind just gets, embarked because you're not just paying for the purchase price. There are all these other costs that come in. So because these are property taxes that are taxes for after acquisition, would they be expensed or capitalized?
Expensed.
Good, because this is the amount that you would, these are the property taxes because of you owning at the time that you owned the property. Now, if these were delinquent property taxes, then those would be capitalized. But because these are after acquisition, that 36,000 would be expensed. Now, state transfer fees for the state's property tax rolls, as they're called, they would have to transfer the ownership from the seller to the buyer, and they charge a lot of money to do that. And I say a lot of money. You would think it would cost only $20 for them to transfer it, but for most states, it's in the thousands that you've got to pay for this. Blows my mind. So we had transfer fees of $4,000. Would that be capitalized or expensed? Do we have to incur that cost in order to get the asset ready for its intended use?
Yes.
Yes. So if the answer is yes, then what do we do with it, Katone?
Capitalize it.
Good. We would capitalize the 4,000. Okay. So we would capitalize the 4,000. It says an independent appraiser estimated the fair values. The fair values we're going to need in order to learn how to allocate the total capitalized cost. And then it says shortly after acquisition, the Samtec, who is the buyer, spent $82,000 to construct a parking lot and then $40,000 for landscaping. So we will see what we have to do with that cost that was done after we had acquired it. So right now,
There was also the legal fees for drawing the contract.
oh, thank you. Yes. So we've got legal fees, and the legal fees for doing the contract, would that be capitalized or expensed? Thank you. I think that was Taylor reminded me about that. So what would we do with the legal fees for doing the contract?
Capitalized.
Good, capitalized, because you have to have an attorney involved with this, and they're drawing up the contracts, and we got to have a contract to purchase the property. So again, that would be capitalized. So the total cost for that we would capitalize is the sum of, so the total cost that has to be capitalized is the $4,025,000. Okay. So now we need to divide this, because what we acquired was land and a building. And so we need to allocate this $4,025,000 between the two. And we do it, this is going to remind you about how we allocated the transaction price to each of the performance obligations. You remember that we did that based on standalone price? The concept is exactly the same. Let me insert a couple of rows here. And so we do it based on standalone price, which is the fair value. FV is, well, is the fair value of the components that we purchased. And what was the fair value of the land itself? So what did it say?
3.3 million.
Right, 3.3 million. And what was the fair value of the building?
1.1 million.
1.1 million. So what is the total appraised value of the property that we acquired?
4.4 million.
Good, 4.4 million. So this is like your standalone price. So the land is what percentage of the total price? $75%. And obviously the building would be 25%. Okay. So then we need to allocate, my total purchase price is the $4,025. And so 75% is equal to my total capitalized cost times the percent would be the amount that would be for the land. Now notice in my, Excel, again, I'm just using good Excel techniques here, and that I wanted to anchor the total cost. So I then could, copy it down. And why didn't it copy down? Oh, because I anchored the wrong one. Sorry about that. Ugh. And we see that 3,018,750 would be allocated to the land. This 1,006,250 would be allocated to the building. So when I look at the problem asked us then to look at what would be reported as the assets. So what would my assets look like on the long-term assets? I'm going to use LTA, which is the abbreviation for long-term assets. So the long-term assets that I would have would be the land, which is at the 106,250. The building, which is the 106,250. And then I would have land improvements, which is another type of tangible asset, land improvements. And my land improvements would include the parking lot that we paid $82,000 for after the acquisition and the landscaping. Now, and the landscaping was $40,000. Now, it's interesting to think about landscaping as being capitalized or expensed. You know, you think about long-term assets are going to be around for a long time. So this is the type of landscaping that is the permanent or semi-permanent landscaping that is done where, you know, they come in and they dig the beds, you know, to put the plants and all in. So that's what they're talking about here is the expense that you have to do, like if they've got to put grass down, you know, to put the sods of grass down that are going to be around, you know, for a long period of time. This isn't talking about the annual flowers that, you know, companies plant and then, you know, they're annual, so they die every year and then we replace them. Those would be expensed. So the landscaping that they're talking about here is the part of the landscaping that would be around, you know, for a long period of time. Okay, not just the annual flowers that we put in. Those would be expensed. Okay, so this is how it would. This is in our long-term asset section with respect to this that we would have on our balance sheet. Now look at requirement number 2. Did anybody have any questions about that? Pardon me?
Land is a 3,000, 3 million. The land, I think it's wrong with the land.
Oh, yep. Thank you for that. Yeah, this should be equal to the land. Thank you for noticing that. I hit the wrong one. I'm telling you, I'm still in getting better or working on getting better. All right, so thank you, Ms. Pham, for that. So this is what would be reported on our balance sheet. Now, I did this in Excel pretty quickly. Were y'all able to do it using your calculator and understand how to allocate based on standalone price? Were you able to remember how you did it in Chapter 6? It's the same thing, based on standalone price. So does anybody have any questions about that before we move on to requirement number 2? All right, in requirement number 2, it says same thing as requirement 1, but immediately after the acquisition, the company demolished the building and then it gave us what the demolition costs were. They were able to sell some salvaged materials from it. And then they spent $86,000 clearing and grading the land, because in requirement 2, the assumption is they didn't want the building, that their intention was they really just wanted the land and weren't going to use the building. So now let's take a look at what our capitalization would look like. I'm just going to copy and paste. So what cost would be capitalized for the land? We would not have any allocation to a building because we wanted to get rid of the building. So I'm going to let you work on this one for a minute or two, and let's see. God bless you. Y'all don't know how happy I was that my body started improving with antibiotics, because antibiotics don't help this virus. And whew, man.
You had the test about that?
No, I did the, we have our insurance. Well, it's called Teledoc, where you can have an appointment over video or telephone with a doctor. And that's what I did. And they didn't recommend that I go get tested unless I didn't respond to antibiotics given my symptoms. So no, I have not been tested. But given that I am responding to the antibiotics, it doesn't appear that I have the COVID-19. I don't know, but I thankfully have gotten better. So thank you for asking. All right, so we know that the y'all keep working on it. So we know that the $4 million would be capitalized. We already talked about that the title insurance would be capitalized, that the property taxes would be expensed, and that our state transfer fees would be capitalized and legal fees would be capitalized. Now we capitalized the demolition of the building. Why? Why did we capitalize the demolition of the building?
We didn't need that building, and
Good. Good, Katone, because we didn't need the building.
we
What
wanted
was our intended use, Katone?
to just have the land.
To just have the land. So we would capitalize the building, the demolition of the old building, and then in order to clear and grade the land, as we had previously talked about, this 86,000 would be capitalized. Now, what do we do with the salvaged materials? This happens, quite a bit. People are interested in old brick and copper, copper wiring and all. So they can sell some salvaged materials. Would the salvaged materials be, when I sold them and got the cash for them, would I debit cash and credit a revenue? Would this be a revenue? Or does it reduce the cost of my land?
It reduces the cost of the land.
It does, exactly. It reduces the cost of my land. So that 6,000 that I got would reduce the cost of your land. It is not revenue. It actually reduces the cost of the land. Good, Katone. So the amount of cost that would be capitalized for the land, so this would be total cost for land, would be $4,355,000. There is no allocation to do because I only purchased land. That was the intent of what I wanted to purchase. Okay, so that is how we handle lump sum. Again, it's based on the fair value, which is the standalone price of each asset that we did here. And then we calculated what percentage each component of which we are purchasing is of the total standalone price, and then multiplied it by the amount of cost that was capitalized. Okay, so that is a lump sum purchase. Now let's talk about, I'm going to stop sharing. Now let's talk about intangible assets. What is what makes an asset intangible?
You're not able to see it.
Good, y'all all are right. And I hear each one of you, and I like to speak up like we did in class. Right, it doesn't have any physical substance. And what are some of the examples of intangible assets?
Patents.
Copyright, trademark.
Copyrights, patents, franchise right fees. Daniel, can you think of one? Taylor, Lillian?
Goodwill.
Okay, goodwill, and we're going to learn how to calculate goodwill. Trademarks, right? I don't remember if somebody may have said trademarks and patents. Important information, and again, this is on your on the notes, that I had word processed for you. That only purchased intangibles are capitalized. Internally generated intangibles are not capitalized. For example, companies want to develop what's called goodwill within their company. I'm an entrepreneur. I start my own business, and I have a balance sheet of that business that has, my assets and my liabilities on it. And I hope to be able to sell my business in the future And I would like for that selling cost or my selling price to be higher than what the fair value of my net assets are. Now, who remembers the definition of net assets? We learned it in chapter 1. What is the definition of net assets? See, Taylor, are you going back to your chapter 1 notes? Right?
Is it assets minus liabilities?
Good, Tanisha. It is assets minus liabilities, which also equals what, Tanisha?
It's equity.
Equity, perfect. Okay. So net assets are assets minus liabilities. So if I take the fair value, and we're going to talk about how we calculate goodwill in a minute. I'm trying to just talk about the concept of it here, that I've got the fair value of my assets, and I subtract the fair value of my liabilities, I end up with the fair value of my net assets. So let's go back to our entrepreneur. Started a business and, wants to obviously have a successful business where this business grows, this business, the branding of the business, the reputation of the company is, it's known. This company is known for their quality of their service, the quality of their product, whatever it is from a marketing standpoint that they have tried to brand themselves as. So that hopefully one day I could sell my business. You hear about stories like this where entrepreneurs, start a business and then are able to sell it, years later after they have grown the business into a reputable business, that they're able to sell the business for more than the fair value of their net assets. Well, why would somebody be willing to pay more than the fair value of what they're actually getting? The fair value of the net assets. What are you acquiring? So I pay, $500,000 more than the fair value of my net assets. Why would I be willing to pay $500,000 more than the fair value of the net assets? What else am I buying that this company has done? You're buying that what's it's called goodwill, but you're buying goodwill means the reputation that this company has built for itself. They have internally generated this goodwill. This company is known for their quality service, their quality product, their innovations. And so all of these esoteric things, I can't touch them, but they have added benefit to the company, is again, the reputation, the branding that this company has been able to develop. Well, when this company the entrepreneur owned this company, they are internally generating goodwill, the reputation of the company. They're internally generating this intangible asset, but it is not capitalized. Only purchased intangibles are capitalized. Okay, so when we look at goodwill and we get into the number crunching of it, we're going to talk about why on some companies we see the asset goodwill and on other companies we don't. Let's look at a patent. A patent is something that generally results from research and development. Companies, you take a pharmaceutical company, and they have been spending a lot of money in research and development costs in order to try and find the vaccine for COVID-19, okay? So they're spending a lot of R&D, research and development costs, and they hope that the results of all of their R&D costs that they are expending is that they will be able to acquire a patent. Well, they are internally generating the information necessary to acquire the patent by expending R&D cost. And in chapter 10, we learned that R&D cost, do we capitalize or expense research and development cost?
They're expensed.
Good, we expense it, okay? So we're doing all this R&D cost. Some of our R&D projects end up with nothing, bust, it didn't work. But the successful R&D products, R&D cost, research and development cost, may end up with a successful patent. Wouldn't you like to be the company that ends up with the patent for the vaccine on COVID-19? So the cost that would be capitalized for the patent would be the actual cost of purchasing the patent. We have to hire an attorney to get a patent. They're called patent attorneys that specialize in it in order to protect your intellectual development, your intellectual properties. So we've got the cost of an attorney to help us get the patent. You've got to pay a fee to the patent office. So that would be a cost of acquiring the patent. So any cost that we have to pay to actually acquire the patent are capitalized. But the cost that we have from internally developing what is necessary to get the patent is not capitalized. You think about the intellectual property that the scientists have. That's not capitalized. The R&D cost that I am doing internally to hopefully get a patent is expensed, okay? So anything that the company is doing internally to generate intangible assets are expensed. It is only the cost that are necessary to acquire the patent itself that are capitalized, okay? So again, only purchased intangibles are capitalized. Only purchased intangibles are capitalized. Internally generated intangibles are not capitalized. The second thing with respect to intangibles are intangible assets are categorized into two types of intangible assets. Those that have a definite life and those that have an indefinite life. Indefinite life meaning that it'll go on into perpetuity. So let's take the patent that we were talking about. When you acquire a patent from the patent office, the federal agent, the patent office, which is the federally issued patent, the patent has a legal life of how many years? What is the legal life of a patent?
20 years.
20 years, right? And so the legal life of a patent, you think about, you know how we have drugs and they have generic drugs? Well, generic drugs happen when the patent of the original drug is no longer in effect. Like after the 20 years, then companies can start developing generic drugs because the patent, the legal protection of that intellectual property is gone after 20 years, after the patent has run out in 20 years. That's where you get the generic drugs from, just FYI for your information. So the legal life of a patent, it has a definite life. It has a definite life. The cost allocation of definite life intangibles is called amortization. Okay, so intangible assets that have a definite life are amortized. It is the exact same concept of depreciation. It is cost allocation over the useful life of an asset. But instead of calling it depreciation, we call it amortization. Okay? So intangible assets that have a definite life are amortized. Patents would be one of them because they have a definite life. Now look at trademarks. Trademarks have, when we first get a trademark, looking for the page, oh, here we go, 522 and 523. Patents, the 20-year life, you see on page 522 where they talk about it. Now, when we purchase a trademark is good for 10 years. However, we can continuously renew our trademark. You think of, when I say swoosh, what company do you think of?
Nike,
Nike, Golden Arches,
McDonald's,
right? Clydesdales. Come on, think about your Super Bowl commercials, huh? Budweiser, exactly, Aaron, Budweiser, okay? So trademarks, because you can renew your trademarks. You think about Mickey Mouse, right? Disney. You know, that is trademark protected. So although it has a 10-year life, because you can renew it into perpetuity, it is considered to have an indefinite life because I can renew it in forever and ever and ever and ever. You know, you think about the 5 rings. When I say the 5 rings, what are they? Red, yellow, black, white, and blue?
Olympics.
The Olympics, exactly. They have continuously renewed that trademark, and that trademark is protected, although they have to renew it every 10 years. Okay. So because of that renewal, it is an indefinite intangible asset, and thus it will not be amortized. It will not be amortized. Okay, so, and then you could read about franchise fees and, you know, the other types of assets, intangible assets. I want to look at goodwill specifically. Goodwill, as we just talked about, is an internally generated asset. That is the branding that a company has for itself. You know, its culture, what it's known for, it's goodwill. Why somebody would pay more for a company than the net asset, than the fair value of the net assets that they're acquiring. Well, the company that is internally generating this goodwill, because it's being internally generated, would not have goodwill on their balance sheet. But we do see goodwill on some companies' balance sheets. Why? Why do some companies have goodwill on their balance sheet, meaning that it was capitalized, and some companies do not? What is the only way to get an intangible asset capitalized?
Is it because they bought other companies?
You got it, Tanisha. Exactly. Remember, only purchased intangibles are capitalized. So if you have purchased a company, as Tanisha said, if you have purchased a company, then you have, and you paid more than the fair value of the net assets, then you have purchased the goodwill. So when you see goodwill on the balance sheet of a company, that means that they have purchased that goodwill. That means they've purchased another company. Okay, so let's take a look. You can see on page 524, you looked at illustration 10.8 and saw how to calculate goodwill. Let's work an exercise. And let's take a look at well, there is one in here, and anybody see the exercise? Oh, goodwill, there it is, exercise 10.6. Exercise 10.6 is on page 554. All right, so here on March 31st, again, I'm going to bring up an Excel spreadsheet. And it gives us information about the book value and the fair value of, oh wait, did I share my screen? I don't think I did. Sorry about that. You should tell me, Bostic, I'm not seeing them. Sorry about that. There we go. All right, so you can see that it's given us information about the assets and the liabilities that Wolfson is acquiring. They purchased all of the outstanding common stock of Borney Corporation for $17 million. And they give us the book value and the fair value of the assets and the liabilities. And it says calculate the amount of goodwill. Now, am I interested in the book value of these assets or the fair value of these assets for calculating goodwill? Katona said something.
The fair value.
Pardon me?
The fair value.
Fair value, good. Nicole, is that where you were going? Okay, good. The fair value. Okay, so I'm going to look at the fair value of what we are acquiring. And we acquired current assets, property, plant, and equipment, other assets, current liabilities, and long-term debt, long-term liabilities. Okay. And the fair value of my current assets was 7.5 million. And the fair value of my property, plant, and equipment that I'm acquiring was 14 million. Oh, man. Put in an O instead of a 0. Boy, for this accountant. The fair value of my other assets is 1.5 million. And my current liabilities, the fair value was 4 million. And of my long-term liabilities is 5.5 million. Okay. So the fair value of my net assets is 13,500. I assume that you understand why I subtracted the liabilities. So the total fair value of the net assets is 13,500,000. Now, what was my purchase price of the company? How much did I pay for the company?
17 million.
Good. I paid 17 million. I paid 17 million for the company. And so how much more did I pay for the company than the net assets that I actually acquired?
3.5.
Good, 3.5 million. So this company, would actually, when they purchased it, they would actually debit each current asset. They would debit, each property, plant, and equipment, and debit their other assets. They would list each one. Then they would credit, their liabilities, and they would credit cash for 17 million, and they would have to debit goodwill for $3.5 million. So this is how, as Tanisha said, that we end up with goodwill on our balance sheet, because it is one of those purchased intangibles. It is one of those purchased intangibles. Internally generated goodwill, not on the balance sheet. Purchased goodwill is on the balance sheet. And goodwill is one of the intangible assets that has an indefinite life. That has an indefinite life. So any questions about calculating goodwill? Remember to use the fair value of the net assets, not the book value. All right. Now, the other type of assets that we have are natural resources. Natural resources. Look at the sheet that the chapter notes sheet, that I word processed. And natural resources, one, the cost allocation is called depletion. Okay, so I just wanted to, we'll talk about depreciation and how to calculate depreciation, how to calculate amortization, and how to calculate depletion expense in chapter 11. But I wanted you to associate what we call the cost allocation of each of them by their different names. Depreciation is cost allocation for a tangible asset. Amortization amortization is cost allocation for intangible assets, and depletion is cost allocation for a natural resource. Now, what costs are capitalized with respect to natural resources? You will see on the chapter notes that I gave you that there are 4 costs that are capitalized. The acquisition cost, what I paid for, let's say it's a coal mine, okay? So whatever I paid for the coal mine itself. Exploration cost. Exploration cost is, we've got geologists that, have got to explore, how much coal does this land have in it? Okay, so they're exploring where is the coal? How much coal is there? So whatever costs they incur in order to explore the natural resource that they're looking for. I bought some land and I'm looking to see if it has oil and gas on it. So all of the exploration costs to see if there's oil and gas on it would be capitalized. Another cost is the development cost, okay, the third type. So let's go back to our coal mine. We found where the coal is, and now we've got to develop the, you know, the tunnels that you see in coal. I have never seen a coal mine personally, but the tunnels that you see that are developed and they have the rail to put the coal carts into. Have y'all seen these on television when they have, do y'all know what I'm talking about? Okay, so they've developed the tunnels. They, you know, put in the necessary rails, all what they have to do in order to get the coal out once they've explored and found where the coal is. So they're going to have development cost. The fourth cost is restoration cost. The acquisition cost, the exploration cost, and the development cost will be given to you. Restoration cost is cost that companies are legally required to incur when they abandon the property. You take a coal mine and they have extracted all of the coal out of the coal mine. There are federal laws. Y'all heard of the EPA, the Environmental Protection Agency? The EPA has laws that companies have got to restore the property to a certain level. You know, I like to think of it as, you know, they have to restore it to a place where people could live again, you know, into a park or, you know, whatever, but they've got to restore the property. They can't just leave it as this probably contaminated land, right? Because there's been chemical spills and everything else that have gone into it. So it's called remediation. They have to remediate the property in order to get it into where people could live around it or own it, okay? So that is your restoration cost. Now I'm just acquiring this coal mine. When am I going to pay for the restoration cost? When is that going to be incurred? Today, tomorrow, or in the future? I mean, am I going to be doing restoration costs when I first acquire it?
In the future.
No, right. So restoration costs are going to be paid in the future, yet I have to capitalize restoration costs the day I acquire the property. So how do we do that? Well, obviously we've got to have engineers and geologists or whatever experts that it takes to estimate what restoration cost will be. So let's go look at page 519 and 520. So at the bottom of page 519, you critically read the explanation where Jackson Mining paid $1 million for 500 acres of coal land. And they had exploration cost of $800,000. And then they had development cost of $500,000. And they also had to buy some equipment. We'll talk about the equipment shortly. But because they're required to remediate the land to a condition suitable for recreational use, they're going to have to incur restoration costs when they have extracted the coal. And they had engineers, and the engineers came up with, there are 3 probabilities. That there's a 30% probability that the restoration cost will be $500,000. There's a 50% probability that the remediation cost will be $600,000, and a 20% probability that it will be $700,000. Okay, now y'all gonna need your BA2 pluses, because calculating restoration cost, remember, it's going to be paid in the future, and any time that we have cost across time, we've got to use time value of money concepts. So I need to know, what is the present value of my restoration cost today, because that's the cost that I need to capitalize. So when you look on page 520, you see that they multiplied where did they get, when y'all were reading this, where did the 468,360 come from? Did you critically read that illustration to understand where our numbers came from? So based on those probabilities, they came up with restoration cost was 468,360. What did they do?
The cash outflow times the probability.
Okay, good. So they took the outflows times the probability. And do you see where they have the asterisk of where it was capitalized? So the 500,000 had a 30% probability. 30%, as Catone said, we multiply it by the probability, is 150,000. Does everybody see where I am? And then they had the 600,000 times the 50%. And when they summed up the probabilities, they ended up with a probability of 590,000. Now they estimated, when you read on page 519, when you read it, the problem is said that Jackson thought that it would take them 3 years, was it? Where does it say?
3 years, yeah.
Pardon me?
3 is right.
3 is right. Okay, thank you. That it was, I was just trying to remember from doing this, that they thought that they would extract the coal, that it would take them 3 years to extract the coal. So the restoration cost would be paid 3 years from now. So they had to calculate, I want you each to calculate the present value of the 590,000. Now they gave you the information that the interest rate should be 8%. Okay, that the company's credit risk-free interest rate is 8%. And what we're doing now is what I consider critically reading the textbook. I would have expected that you would have done this when you were reading the chapter. You know, when I saw the 468,360, where did that number come from? And actually recreate the calculation. That helps you with understanding what you read. So 3 is in, 8 is I, 590,000 is the future value, because that was the probable amount using, you know, probabilities. That's the amount that they expect to pay in 3 years. So 590 is the future value, 0 is the payment, and then I computed the present value, and I got 468,361. All right, they got 468,360 because they used the tables and just rounding. That's all that is. It's just rounding the $1. So the restoration cost is the present value after you have calculated the probabilities and added them up. All right. So you see the journal entry that would be done. If I'm going to pay something in the future, then that is a liability. And what is the name of the liability that is created because of this restoration cost?
Asset retirement liability?
Good, the ARO, asset retirement obligation. So you can see on page 520, the journal entry that was done, you know, where they debited the coal mine for the $2,768,360. They showed you, you know, the acquisition cost, the exploration cost, the development cost, and then the restoration cost. The 4 costs that we have that are capitalized for natural resources. And the cash that they paid was $2.3 million. The $468,360, of course, is going to be paid in 3 years. So we have a liability, the ARO liability, asset retirement obligation. Now look at below, and do you see where they have year 1, year 2, and year 3, and they have accretion expense? If you think about the general ledger account, the ARO account, you're first going to credit the ARO account for $468,360. Now, how much do they expect that they will actually pay at the end of the 3 years? What was the amount that they expect to pay at the end of the 3 years? Ryan? Ryan? So how much do they expect to pay at the end of the 3 years? Ashley?
$590,000.
Perfect, 590,000. So you want at the end of 3 years, the balance in the ARO account needs to be 590,000. Right now, it's 468,360. So how do I get it from 468,360 to 590,000? Well, every year we have to calculate accretion expense. Accretion expense. The formula for accretion expense is carrying value times the rate that you use to discount it, the 8%, times time. Now on this particular one, they're assuming that they don't tell you the date, but I can tell by the calculations that they bought it on January 1st. So you see that the initial carrying value of the ARO is 468,360. So 468,360, the carrying value, times the rate, 8%, gives you the 37,469. Okay. Now, if I had purchased this property in September, say I purchased it September 1st, then I would have to multiply the 37,469 times, if it was purchased September 1st, September, October, November, December, times 4/12. Okay. Now they didn't here, so this is the assumption that they purchased this coal mine on January 1st. On January 1st. Okay. So the accretion expense for the first year, assuming it was purchased on January 1st, is 37,469. Debit accretion expense and credit the ARO. for 37,469. Now my new carrying value is the 505,829. So 505,829 times 8%. Of course, this one would be a full year, even if I had purchased it on September 1st of the prior year. And you would debit accretion expense and credit the ARO. And you would do this for the third year, so that by the time you did the third year of accretion expense, then the ending balance of your ARO would be the 590,000. Okay. Let's take a look at exercise 1017. I believe it's exercise 1017. Exercise 1017 is on top of page 556. Nope, it was exercise 10. Oh. Exercise 10.4, sorry. So let's look at exercise 10.4, and we've got a copper mine. Now I'm going to pull up Excel again and share my screen. Am I sharing my screen?
Nope.
Nope. All right. So on exercise 10.4, we have Jackpot Mining Company operates a copper mine, and they paid so we have our acquisition cost. I've got exploration cost. I have development cost, and then I have restoration cost. I didn't spell that right, but restoration cost. All right, so the acquisition cost is $1 million. I don't know about y'all, but I always have to have my commas in there to make sure I've got the right number, not 100,000 instead of 1 million. So we had 1 million as our acquisition cost, and they had 600,000 to prepare the mine for extraction. So the 600,000 is their exploration and development cost. They didn't separate the two. There we go. So they didn't separate between exploration and development cost. It doesn't matter. So we've got exploration and development cost of 600,000. And then they gave us the information about the probabilities. Now, how long do they expect it to take them to extract the copper?
4 years.
4 years, okay? So in order to calculate my restoration cost, I need to calculate my probabilities, and 300,000 with a 25% probability. And 400,000 had a 40% probability, and 600,000 had a 35% probability. Okay. Now, obviously, these ought to sum to 100%, and they do. So now I need to multiply each one of them by the probability. Oh, crazy girl. And we get that 445,000 is the amount that I expect to pay at the end of the 4 years. Now, is that the amount of restoration costs that I'm going to capitalize?
No.
No. What do we need to do?
The present value.
Good. I need to calculate the present value. I need to calculate the present value of the 445,000. Now I'm about to hard code, so I'm going to do equal. You can be doing this in your calculators also. Equal the present value, and my rate. What was the rate?
10%.
10% was the adjusted risk-free rate. So remember, in Excel, I need to put in 0.1 as my rate. In the calculator, you would just put in 10 and then the I. And the number of years was 4. My payment is 0 because I'm not going to be making any payments during those 4 years. And my future value is the 445,000. And this is an ordinary annuity. So my present value is 303,940.99. So the amount of my restoration cost would be and so the total cost that would be capitalized for this coal mine is $1,903,941. Now this problem didn't ask, oh, so let's do the journal entry. I would debit my natural resource, the copper mine, for the total capitalized cost. I would credit cash for the sum of, I paid cash for the 1 million and the exploration and development cost of 1.6 million. And then I would credit my ARO. What does ARO stand for?
Asset retirement obligation.
Good, my asset retirement obligation for what we had calculated as the present value. Okay. Now this problem didn't ask us to calculate what the excretion expense would be for each of the 4 years, but let's do it because we're required to know how to do it. So let's calculate the accretion expense. Remember, it's the carrying value times the rate times time. Now, when did they purchase this asset? Did it give us a purchase date on this one? No. Oh, no, it just did on some equipment, and we'll talk about the equipment in just a minute. So it didn't give us a date. Again, assume that it is a full year, that it was purchased on January 1st, since they didn't give one. Well, my initial carrying value is the 303,941. All right, and I'm going to change the signs on that, and so that it comes in as a positive. So that is my carrying value. And I know that the accretion expense is my carrying value times my rate, which is 10%. So my accretion expense for the first year would be $33,994.10. Now, what would be my carrying value after my first year? So I would debit accretion expense. I have misspelled that so badly. What would be the accretion expense for the second year? And then now, of course, I could do it quicker in Excel. I know you're doing it in the calculator, but my new carrying value at the end of the first year is, the 303 that I initially calculated the ARO at, times the 10%. And then because I debit accretion expense and credit the ARO, my new carrying value would be increased by the amount of the accretion expense. And so I do that each year and look at what the ending balance of my ARO is at the end of the fourth year. Does that number ring a bell? What does that equal?
The amount expected to pay at the
Right,
end of the year.
perfect. The amount that I expected to pay based on my probabilities, the 440,000. So each year you would debit accretion expense, year 1, year 2, year 3, year 4, and credit your ARO. Now, again, this problem assumed on January 1st, if it hadn't, then, year 1 and the first year and the last year, you would have, partial accretion expense because of the times time. All right, is everybody good with that? So with looking at the notes, we talked about the 3 different types of long-term assets that we have: property, plant, and equipment, tangible, cost allocation is depreciation, and what costs are capitalized. We also learned how to allocate lump sum purchases. We talked about intangible assets, and that only purchased intangible assets are capitalized, and that intangibles are divided into two types, those with a definite life and those with an indefinite life. And only intangibles with a definite life are amortized. We looked at calculating goodwill, one of the intangible assets that we have. And then we looked at natural resources. Natural resources, the cost allocation is called depletion. And the four types of cost that are capitalized are your acquisition cost, your acquisition cost, your exploration cost, your development cost, and your restoration cost. And we looked at how we calculate the restoration cost, because the restoration cost is creating a liability that's going to be paid in the future. And so because it's across time, we knew that we had to use time value of money concepts to calculate the amount of restoration costs that would be capitalized. And then we saw the calculation of that amount, how to calculate using probabilities, how to calculate the present value, and then how we have to calculate the accretion expense for each year of the asset retirement obligation in order for our ARO to equal the amount that we expect to pay at the end of when it's time to remediate the property. Now, looking at our Chapter 10 notes, we need to cover the ways that we finance long-term assets. The one that we need to practice and that we'll start with on Tuesday is non-interest bearing notes, page 527. Please practice that, go over that, and understand what the discount on notes payable is, etc. That's on page 527. So we'll start with that on Tuesday. And then we're going to get into self-constructed assets, calculating interest capitalization. The concept is not difficult, but the calculations, there are a lot. In addition to the notes, there's a decision tree that I usually wrote on the board, but Professor Goodwin used Visio and put it into a decision tree for me. And you can see that the decision tree is also uploaded that we will use for working problems on capitalized interest. How do we calculate the amount of interest that should be capitalized during the construction period? And that's the most difficult part about understanding when we self-construct our own assets. You know, the company wants to build their own corporate headquarters, so they bought that land, they capitalized all the costs of the land. Now, what costs are included for capitalization of the building that I am building? Okay? So make sure that you read or reread the part about capitalized interest. Try and work a problem or using the decision tree, looking at the decision tree after you've read it so that you better understand. And we're just going to be number crunching big time on Tuesday. Okay?
Good.
All righty. It was good seeing y'all again. Sorry about Tuesday. And if you continue to have problems, I will put out some practice problems. If you continue to have problems with dollar value LIFO retail, just email me and we'll set up a meeting. Okay. All right. Thank you all. It was good seeing you again.
Have a good weekend.
Thank you. You do the same. Bye-bye.
Take care.
Feel better.
Thank you. You too.